I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy we haven't had on in a very long time. He is a free-thinking maverick trader entrepreneur. He has a new company out called Veritasium, a new website, Veritasium.com. You know him from the boombustblog.com. I'm talking about Reggie Middleton. That's no longer. We're going to talk about your cutting-edge money, cutting-edge technology that you're coming up with. But I want to talk to you, Reggie Middleton, first of all, about the economy. First of all, welcome to USAWatchdog.com.
Well, thank you. Good to be here.
You're a smart guy. I am remiss I haven't had you on. We've tried, and we've had some technical problems. I've had a lot of technical problems. But anyway, I want to talk to you, first of all, about the economy. I want to talk to you about this Asian Infrastructure Investment Bank and get your take on what it means with all these countries signing up for it. Is this the death knell for the dollar, or what's your view on it?
Well, this is competition for the dollar. I wouldn't call it the death knell. The dollar is deep and white in terms of liquidity and influence, backed by the geopolitical infrastructure and might of the U.S. and the military might of the U.S. and the economic. So definitely not the death knell, but it is competition, healthy competition. If you think in terms of a wolf pack, you have an alpha male, and that is the dominant wolf, and he runs the pack. Every so often, at least annually, you probably have other more dominant wolves in the pack challenge that alpha male for superiority. And the alpha male has to put the wolves down. If he does not, then alpha is now switched into the more aggressive, the more dominant male. And it happens, and that's basically, the circle of life. Think of, can't think of his name. The theory of evolution.
Darwin.
Darwin, yes. Charles Darwin, the Galapagos Islands and everything.
Yes.
So basically, instead of challenging for the alpha male position of wolf pack, we're challenging for the reserve currency. And China is making play, stay put. I don't think they'll succeed, but it is healthy competition, and it keeps America on its P's and Q's. I actually think that America could do more subversive damage or gain more control cooperating and going and joining the Asian Infrastructure Bank than trying to prevent it from happening, since there seems to be enough inertia that it's going to happen anyway. Even our closest allies are going in. As a matter of fact, the only stalwart are Japan, which is a very close competitor to China, and the U.S. Now, these are big stalwarts, but join a bank, and if you have to compete, do it from within rather than from without.
So the idea, the talk that, this is the end of the dollar and the dollar is going to get crushed this fall, and you're saying not in your world.
Well, if the dollar gets crushed, where's the capital going to go into? It's going to go into the renminbi, the yen, the euro. So the dollar, each global economic empire comes to an end. Happened to the British Empire and the pound. Before then, you had the Roman Empire, Spanish, et cetera, But I don't think it's time for the dollar to end just yet, primarily because there is no competitive currency that can take its place. What the Chinese may be trying to do is try and create a basket of currencies to compete with the dollar, but then you have infighting. Once it comes to the point where you might be able to positively compete with the dollar, you have infighting among those baskets because members of the basket, because everybody wants to take that power position. So a smart move on part of the Chinese. It would be successful in probably rivaling the dollar a little more, or the U.S. a little more, but it's not time for the dollar hegemony to end just yet.
So moving on to the rest of the economy, lots of bad news. Retail sales not good. Home sales are looking like they're toppy. Things aren't looking good for the U.S. economy. What is your interpretation of what's going on right now in the U.S. economy?
Yeah, well, saying it's not looking good is possibly a misnomer. It's not looking as good as the marketing arm of the U.S. government wanted it to look, or gave the impression of it to look. We never properly came out of the recession, the Great Recession from 2008, 2009, and a lot of machinations were put into place to try and kickstart growth from a nominal price perspective, but not from an economic value perspective. So prices went up, but value didn't go up to support said prices. And so those prices, in my opinion, are ephemeral. So you had real estate prices and housing prices go up, but you didn't have incomes go up commensurately to support these residential housing prices and the residential yields that were coming off or support yields. So basically, you had price go up. You buy an apartment building, a 4 or 5 unit apartment building. You rent it out $2,000 a month, and then rents increase $20,800 a month to $3,000 a month. But you don't have a commensurate 33% increase in incomes. Now, no matter how bullish you are on the economy, if you're a landlord, you actually want somebody to pay the rents. You can charge whatever you want, but if they don't pay the rents, then at the end of the day, you do lose money and lose value on that investment. And that's what my personal observations in the Northeast area, particularly New York area, we've seen a significant increase in rents. There are some fundamental reasons for it, primarily because you had a lot of foreclosures. So a lot of homeowners who were previously owners then went on to rent, and that put some pressure on rentals. You had a lot of foreclosures in rental properties, a slight decrease in supply, which gave, a relative increase in demand relative to supply, but then supply started, picking up because a lot of people jumped into the rental and the income sector. And then people are now renting single family homes. Not only people, you have professionals, you have amateurs, you have hedge funds who are going in specializing in single family rental. This was a very specialty market before for small professional investors. I'm not very bullish on real estate simply because the fundamentals are not keeping up with the nominal prices, and the macro situation is funny looking. 33% of the sovereign debt in the EU has a negative yield. Negative yields are something now unheard of just a couple of decades. And you have 33%, roughly 33% of an entire economic area with negative yields. That's a guaranteed red sign. That's the big warning letters in 15-foot font, saying warning.
That real estate's going to take a hit.
Real estate should take a hit. Either real estate takes a hit or the economic value and income skyrocket. So, you're going to have a return to mean. So either prices come down or incomes go up.
Do you think that the Fed's going to follow through on their threat? They keep threatening to raise rates. Are they going to be forced into raising rates?
Well, if anything, they'll be forced into not raising rates. I've never fallen for the raise rate mantra. They've been saying it. If you track the media and the Fed's proclamations, they've been saying this for well over a year now. If you raise rates, this is a conundrum that they're in. Rates at zero, close to zero. The banks, they did this to save the banks, okay? The banks still have assets on their books that are worthless or negative value, such as foreclosures. Many houses should be foreclosed upon, but they're not. And then you have houses that are foreclosed upon. A lot of this is sitting on the bank's balance sheets, either as dead mortgages or non-producing mortgages, or as actual REO, real estate, okay? If you raise rates, right, this debt balance sheet will take a hit and will hurt. But you sort of have to raise rates because banks with their net interest margin, NIM, how they traditionally made money back several decades ago, they can't make money because even though they're borrowing money very cheaply, they can't lend it out but so expensively because the average rate is very low. So even if you get the money free, if you have to lend it out 1%, 2%, or 3%, you factor in the risk of the lending, particularly in real estate, expenses, etc. You're break even, partial marginal profit at best. So in order for banks to make money the traditional way, you have to raise rates. But if you raise rates, you really put a strain on the fact that you put a strain at the exact same point that rates are dropped for to begin with, and that's the basically the garbage on the balance sheet. So if I had to bet my life that they'd raise rates, if I had to speculate, my life was in the results of the speculation, I'd say no, raise rates. And if they do raise rates, a nominal rate rise, right, basis points, and then gradually go up. And even then, it might put pressure on it. If they do raise rates, money is going to fly into the dollar. The dollar's going to become even stronger relative to the euro and the Asian currencies. And then you're also going to have a lot of pressure on U.S. corporates because any international business is going to take a significant hit.
So you're saying no way that they're gonna your term they'll be forced not to raise rates. You say the economy is not going to get really any better, and they won't be able to raise rates, won't be able to take the hit. They'll just make it worse.
if the economy gets better, they can raise rates. But why would the economy get better now and they didn't get better last year, year before last, etc.? In order for the economy to get better, you need to flush that garbage out the system. They refused to do that. Instead, they made a bunch of rules. They papered over it. They repealed mark-to-market. Nobody knows what's on the bank's balance sheet. Nobody knows what it's worth. They literally made it legal for the banks to say, we won't tell you what it's worth. It's a conundrum. What hopefully, I can't say hopefully because that's sort of rather foul, but the best bet for the U.S. is to have a China go boom from their bubble or the European QE experiment to collapse. Capital will then flood in to the U.S. and then it will allow rates, natural rates to shrink even more and the currency to get stronger from a natural means. So that extra capital will help the U.S., but it doesn't solve the structural issue that it has. And that is basically lots of garbage on the balance sheet that hasn't been flushed out. It's an interesting situation. It's unprecedented. And simple solutions that are being bandied about, such as raise rates, drop rates, QE, are not that simple because they have unintended consequences, such as having ZERP and QE and even so long has put banks in a situation where they're damned if they do and they're damned if they don't.
Alistair McLeod came on and said, I don't see he's with Gold Money and also has his own website. He said, I don't see any good news. And he mentioned what you mentioned, China's in trouble. They have a huge, debacle going. Europe's in trouble. Just little old Greece could, cause, a daisy chain of events. The economy hasn't gotten better. I talked to Paul Craig Roberts, former Assistant Treasury Secretary. Economy hasn't gotten better. Do you think the economy could, suffer some sort of black swan, some trauma from China, Europe, or just everybody's saying, hey, the QE's not working or whatever? Do you think we could have a lot of people are pointing towards this fall, that we could have some real trouble, real fallout this fall? What say you?
Well, you could say that, but, theoretically, we should have had that trouble back in 2009 and 2010, 2011. There are a lot of forces, powerful forces, trying to kick the ball down the road, Succeeded significantly. But, the longer you kick it, the more the greater the recompense when it's time to pay the piper. One thing, I would think probably the most dangerous threat to the global economy would be contagion from Europe and from Greece. But not because Greece itself defaults. Greece defaults. There's a lot of their assets leveraged on balance sheets, etc., that are not held by the central bank. But this is a danger that Greece causes, and that's Greece's success, which is by far the greatest danger. Suppose Greece pulls out of the Eurozone, okay, and pulls out of the EMU, okay. They return, drop, and there's going to be significant hard times. If they pull it off, and they do no worse than they are being in the EMU and being subject to austerity, then every other entity, every other nation that's subject to extreme austerity is going to look at Greece and say, why in the world are we allowing ourselves to be subjected to this by the Troika and by Germany when Greece was able to pull out? And yes, they did bad, but they did no worse than they did while being subject to austerity. And now they're truly a sovereign nation. They have their own central bank. They could print their own currency, set their own rates. Well, if Greece gets away with it, well, then you have to take a look at Portugal, at Spain, at Italy, at Ireland. And they'll think about it as well. If Greece gets out of the EMU, right, and even partially succeeds, the entire Eurozone experiment is gone. Okay, and it's not unheard of because remember, a lot of people thought that Iceland was just going to burn in hell if they didn't pay the bank loans according to the terms, et cetera, et cetera. Iceland did default on the bank loans, and five out of seven periods of growth, quarters of growth, Iceland was the fastest growing nation in the EZ. And they're not even in the EZ. I'm sorry, they're not even part of the Eurozone. They outgrew Germany, which was the poster child of economic success, 5 out of the 7 economic periods. So it's quite possible.
Go ahead.
Yes, that is my point.
Which is your point that you got to wash out the junk. And
right.
that's what Iceland held their nose and said, we're going to take a hit, we're going to wash out the junk. And that's what you're saying has to happen for things to get better.
You have to. Listen, there's nowhere in the world Greece can repay the loans, okay? They can't afford the interest on the loans, okay? So repaying the loans is something that's not feasible, and that's not really how sovereign finance works. But Greece, from a structural perspective, can never afford to pay the debt service on the loans. So their interest will never get paid. And, and from a structure, their balance of payments won't allow it. So they basically have to default. So if they have to default, why not default wholeheartedly and totally? It makes sense.
How are you protecting yourself? What's your play? Because you're a trader and you're a smart one. You were shorting Apple. I want to tell everybody to know this. You were shorting Apple when it was out $700 a share, and you go, this is going to go down. And boom, kapowie! You were absolutely right. People are like, oh no, I've known it for short Apple, and you did, and you killed him. So you're a big. When I say you're a big thinking maverick, you are a big thinker. How do you think this unfolds, and how do you protect yourself? Because it will wash over here when it blows up in the EU.
Well, I'll tell you a mistake that many institutions make, and because institutions make them, individual investors make them because either they're, have their capital invested in institutions or they try and follow. Don't reach for yield, okay? If interest rates are going very low, okay, you want to get paid for your investment, understood. Don't reach for yield just because yield is there. So don't go and binge on junk bonds, because your typical portfolio is paying 150 basis points. So you're going to reach for a 9, 10, 11% junk bond. That junk bond didn't have NERP and ZERP, probably wouldn't be able to issue debt. If they did issue debt, it'd be priced at 25, 26%. Okay? But because everybody feels that they have to have a return, they reach for return no matter where it is. You have to adjust your return for risk. Everything should be risk-adjusted reward. But a lot of people think of reward without the risk part of the equation, and it's impossible. That's like going to the store and expecting to get products without having to pay for it. You have to think of the price and not just, the actual product. And if you think of the price of the risk and not just if you think of the price of the risk and not just the value of the reward, then things look totally different. NERP is ridiculous. It is absolutely ridiculous for you to pay somebody to borrow your money. Okay? I shouldn't have to go any further. Yet, the reason why you have NERP is that you have sovereign entities and central banks that are trying to discourage institutions from parking their money in their currency. And they do that because they're trying to export employment and export deflation to their neighbor. It's basically stabbing your neighbor in the back. The EU entered this massive QE phase simply because of a trade war with Japan. Japan's 2 or 3 decade, QE experiment has pushed massive unemployment, massive deflation up. And they did a very efficient job pushing it into the EU area. When the U.S. did it, the U.S. did a very efficient job as well, and they pushed deflation and unemployment off into the EU. So the EU is now trying to do it again. The issue is, I think the EU will be as effective as the U.S., and that's still the United States effectiveness is still out the jury. And as for whether Japan was successful, well, do you remember the lost decade?
Yes.
The term? That was 1980 something, 2015, right? So, Japan had a 3-decade lost decade. So does QE work? It keeps the boat afloat, but you're consistently, shoveling bucket water out. There has to be a better way. And I think part of the way is to take your medicine and take significant losses on your bad debt, get the bad debt out the system so you can have the rebirth to the phoenix. So the best way to protect is don't believe there's something for nothing. When rates are low, don't be afraid to keep cash, okay? Or calculate the return on the risk that you're getting. Chances are you're better off getting 15 basis points than you are investing in a 10% bond and taking a 15% loss.
Now, Reggie, for some people, you may be frozen, but I think we still have your audio. So just tell us briefly about your new company, Veritasium. It's loans without bankers, contracts without lawyers, stock trades without brokers. And this is going to launch soon, your new venture, cutting edge, cutting edge in money, brokerage, contracts, banking, the whole deal. Tell us about your new venture.
So what we've done was we've taken the technology behind Bitcoin, called the blockchain, and we've harnessed it to basically intermediate rent seekers. Rent seekers, as an economic term, is an entity or entities that attempt to charge for a transaction without adding requisite value back into the transaction. A perfect example of a rent seeker would be a land baron that just so happens to own the property in front of the only bridge to cross the river. So what he does is he charges everybody to walk across his land across that bridge, but the only value he adds is the fact that he has land there. Okay, so there's no additional value being added in the transaction. What our company does as a software company is we take technology to allow entities to do business directly with each other, hence go around rent seekers and disintermediate them, remove the middleman from the equation. So we allow people to build their own access to the bridge, go around the land baron, and then cross without paying the land baron's rent or tax or undeserved fee. We've started with what I consider low-hanging fruit, and that's the Wall Street brokerage and banking model. And we have the Veritasium wallet, which is a software client that you download. It's a very small download, 30 megabytes. And allows you to load it with digital currency, Bitcoin, and everything's Bitcoin based. Okay, but this is not a Bitcoin value because it allows us to transfer value between any two parties without those parties having to know each other or trust each other or be exposed to each other's balance sheet. So, quick example, you download the client, you can trade over 45,000 tickers in any asset class, stocks, bonds, forex currencies, commodities, indices. You can use as much leverage as you want. You don't have to worry about the other side defaulting. There's no counterparty risk, no credit risk, no default risk, because the Bitcoin blockchain, which is an immutable database, has never been hacked, stands as a counterparty and makes sure that the transaction goes as follows. The transaction itself.
Yeah. So the money has to be there. The money has to be there. There's no leverage. This is the money. This is the blockchain. This is what's out there, and that's your trade, and it's always there.
It's always there. We do allow leverage. We allow extreme leverage, up to 10,000 times, which is, theoretical, but practically is too much. But practically, depending on what you're trading, you could go up to 150 times. The reason why you're allowed to lever is the only amount that you can gain or lose is the amount that you put up as collateral. Okay, so you can lever $1 or $1 million, but you have to put it up front. You turn the leverage up, that means your gain come that much faster and your losses come that much faster. But you never have to worry about the other side not paying because they put their assets in up front and you put your assets in up front.
And for more information about this, people can go to your Veritasium.com. I'll put a link on it at the end of the interview where people can read all about it. It's cutting edge time. When is it launching? Just give us that.
It's available right now. If you go there, it's in beta phase. You could get anything you want. You could go up there, go to the download link, download the wallet. We have spreadsheet trade illustrators to model the trade out. Tons of research for trading oil, crack spreads, stocks, bonds, any currency pair, exotics, made any amount of. You never have to worry about the exchange going bust. You can't have Man Financial. You can't have Bear Stearns. You can't have Lehman Brothers. We're a software company. We're not a financial entity. So at no time do you ever have exposure to our balance sheet at all. This is a new way of doing things.
Well, I will direct people to your website. People can also contact you. I'm sure there's a contact page on your website. Reggie Middleton, you are an entrepreneur, and your new product, Veritasium.com, a link at the end of this to give more about it. Very complicated. I'm sure a lot of people have questions. Reggie Middleton, thank you for coming to us from New York.
You're very, very welcome. Good to be here.